Can debt-fueled growth survive higher rates? Or does the math eventually turn on us? That's the question. For a decade, money was nearly free. Corporations borrowed to expand and to buy back stock. Home buyers stretched for bigger mortgages. Governments ran deficits and rolled them with a shrug. Low rates made almost any plan look smart. Then rates rose and kept rising. Suddenly, the same balance sheets that looked efficient at 2% started to look fragile at 6%. This isn't about vibes. It's about cash flows, maturities, and who has to refinance when. Start with the engine room. Growth funded by debt works as long as three things line up. The cash earned on the borrowed money exceeds the interest you pay. You can roll your debts when they mature, and lenders still believe you. Low rates made all three easy. Cheap coupons lowered the bar for success. Refinancing was a formality. Belief felt automatic because everyone was making their numbers. Higher rates flipped the script. The hurdle rate rises. Rollover gets harder, not because doors slam shut, but because the terms change. Belief returns to where it always lived, in the spreadsheet math of coverage ratios in time. If you've never stared at an interest coverage ratio, here's the plain English version. It measures how many times your earnings can pay your interest bill. When rates were near zero, even mediocre projects had plenty of coverage. Raise the coupon, and the same earnings buy you much less runway. This is where the phrase zombie company comes from. Firms that can pay interest but can't pay principal or invest for the future. Low-rate eras quietly breed zombies. High-rate eras expose them. History gives us how this plays out. In the early 1980s, Paul Volcker crushed inflation with double-digit rates. That shock didn't just hit stock prices, it forced a cleanse. Weak borrowers lost access. Strong ones survived with scars and productivity gains. The lesson wasn't debt is bad. It was debt only works when profits outrun the coupon and the rollover window stays open. Fast forward to Japan in the 1990s. After a gigantic asset boom, debt lingered on bank and corporate balance sheets while growth flatlined. Rates fell to near zero to keep the system from cracking, but the weight of old debts dulled animal spirits for decades. Carrying cost matters, even when it looks small, because it directs management attention to survival, not innovation. There's also a timing trap. Debt doesn't adjust to new rates all at once. It adjusts at maturity. That's why you hear the phrase refinancing wall. Imagine 1,000,000 doors in a hallway. Each door is a maturity date. When rates rise, you don't hit all the doors today. You hit them as you walk the hall. The further you go, the more expensive each door becomes to pass through. In corporate land, this shows up as interest expense creeping up quarter after quarter, even if the firm hasn't borrowed a new dollar. In commercial real estate, it shows up as cap rates moving up while leases reset slowly, pinching cash flow just when a building needs a new loan. In sovereign finance, it shows up as a larger share of the budget devoted to interest, crowding out other priorities or forcing new taxes. The quietest kind of austerity. Households feel the same physics through mortgages and consumer credit. If your mortgage is fixed for 30 years, higher rates don't slam you today. They slam the housing market's ability to clear at yesterday's prices. If your mortgage floats, higher rates slam you now. That's why some countries suffer faster. More variable rate loans, shorter mortgage terms, or fewer avenues to refinance. The math isn't moral, it's mechanical. Who pays depends on how contracts are written. Debt booms also change what companies do with borrowed money. In long, cheap money cycles, many firms stopped borrowing to build the future and started borrowing to buy the present. Stock buybacks, expensive acquisitions, the kind of financial engineering that flatters earnings per share without raising the factory's output. When rates rise, that game becomes expensive. A CFO who could issue 5-year debt at 2% to buy back stock suddenly faces 6 to 7% paper. The buyback becomes a bet, not a sure thing. And if demand cools, earnings fall just as the interest bill climbs. Private equity lives at the sharp end of this. Leveraged buyouts made sense when the spread between the return on the business and the cost of the debt was wide. Shrink that spread, and deals that penciled perfectly in 2021 look tight in 2025. The same math hits commercial real estate. Office towers bought at 3 to 4% cap rates funded with cheap floating debt now meet a world of higher financing costs and tenants who want less space. Even if the building stays full, the debt service eats more of the rent. That's negative leverage, and it ruins the story fast. Emerging markets learned this lesson the hard way in 1997 and again in the taper tantrum years later. Borrowing in someone else's currency is a different sport. When the dollar is cheap, dollar debt feels harmless. When the dollar strengthens and global rates rise, your local currency revenues shrink in dollar terms while your dollar payments don't. The math forces spending cuts or bailout talks. This is why debt-fueled growth in a rising rate world can snap without much warning in countries that looked fine a year earlier. It's not a character judgment. It's an FX mismatch. Governments are not exempt. Sovereigns loved low rates as much as households and companies did. Rolling big deficits at 1 to 2% felt painless. As bonds mature into a higher rate world, interest consumes more of the budget. The temptation is to pretend the bill isn't rising and to talk about growth paying for itself. But interest isn't a political opinion, it's a line item. Eventually, you either spend less elsewhere, tax more, inflate away part of the burden, or hope for a productivity boom that outruns the coupon. Hoping is not a plan. Productivity takes time and investment, which get harder under tight budgets. So the question becomes, can debt-fueled growth adapt? Yes, but only if the growth part gets real. Higher rates are a stress test that separates borrowed demand from earned productivity. Projects with genuine cash-on-cash returns survive. Projects that needed free money to look viable don't. The same goes for companies. Firms that can raise prices, cut costs, or reinvent their product line to widen margins can carry more debt. Firms that relied on rollovers and momentum face a reckoning. That's not macro doom. That's capitalism doing the uncomfortable part of its job. There's also a silver lining to expensive money that we forget in easy times. Higher rates force choice. They reward discipline. They put a price on time. When capital has a cost, junk ideas die faster and good ideas stand out. Savers get paid something for waiting, and lenders stop throwing darts at anything with a pitch deck. It doesn't feel good in the transition, but the destination can be healthier. Fewer zombies, more builders, less noise. What does this mean in the trenches where people actually money and run businesses? If your plan assumed cheap rollover forever, rewrite the plan. If your margins are thin, now is the moment to make them thicker. Automate what can be automated, renegotiate what can be renegotiated, and trim what doesn't carry its weight. If your revenue is cyclical, don't load your balance sheet with floating rate debt that resets at the worst time. If you earn in one currency and owe in another, match the two. None of this is glamorous. All of it is how grown-ups dodge solvency scares. For households, the translation is simple. Fixed beats floating when the world is volatile. Buying less house than the bank says you can afford beats trusting that refinancing angels will appear. Holding a sane emergency fund beats maximizing every last basis point of return. And if your job is tied to cheap credit, construction, speculative development, early-stage ventures, diversify your skills so higher rates don't put your paycheck at risk. This isn't fear. It's respect for math. There's a final misconception worth retiring, that higher rates automatically mean recession and lower rates automatically mean growth. Rates are a price, not a spell. If an economy uses capital well, it can grow with higher rates. If it misallocates capital, it can stagnate with low rates. The 2010s taught us that zero isn't a growth guarantee. The 1980s taught us that pain can reset the board for a stronger run. The deciding factor isn't the level of rates. It's whether the money, whatever it costs, finds its way into productive uses instead of paper tricks. So can debt-fueled growth survive higher rates? It can, but only after shedding the part that was fueled without being growth. The era of effortless rollovers and free optionality is over. The era of earned returns is back. That may sound harsh, but it's also clarifying. Balance sheets will be rebuilt on sturdier terms. Projects will need to stand on their own feet. Companies will rediscover that profits, not leverage, pay the bills. And households will rediscover a quiet truth our grandparents knew. The best kind of interest is the kind you earn, not the kind you owe. If this helped put the moving pieces into plain English, stay with money lore. We make the machine understandable. So whether rates fall, rise, or stall, you're not guessing. You're reading the cash flows, watching the maturities, and keeping your future priced in reality.